From 2020. First thing we do is we lay out the blank document. So you're asked in this case to do a statement of capital. So that's at the beginning of the year. What are the assets and liabilities, and the difference between them must be in the capital, the money that was invested in the business either at the beginning or over the years. Then you have to do enterprise analysis. So if you do a comparison with club accounts, this is like doing a bar trading account. In this case, we have to do it for two areas usually of the farm. So in this case, it's got cattle and milk and sheep. And then we'll put the profits. So if we have the profit for cattle and milk, and then we'll add that then to the profit for sheep. So we know that we will have to do that. And then there will be other sources of income. So we might receive grants or something else. Now, grants, these are regular things you get in. If you get a grant, let's say to buy equipment, that's a one-off. So that would actually be in finance buying a balance sheet if you're asked to do that. So the expenditures then are any of the bills that are associated with just running the farm. So I would say maintenance of equipment, an expense that is specifically for one area of the farm or the other. Well, we deal with that. We put that into the enterprise analysis for that particular area of the business. Again, let's just see what else we're asked to do with this one. So we're asked to do general profit and loss, which I've just shown you there, and a drawings account. So a little unusual, doesn't come up very often. So just to double check, so drawings, I'm just going to put above here, what type of account are drawings, asset, liability, expense or income? Well, drawings actually reduce the value of the liability capital because the owner is taking something out of the business, so he's making his capital smaller. So drawings is an asset account. So any time that we take money out of the business, it will all be on the debit side, and what's left then is going to be the balance, CD, and that's the figure then that I'm going to end up putting into the balance sheet if you're asked to do a balance sheet. Now this appears in the first section of the exam, so therefore it tends to be a shorter one. They would ask, if they put it in section 2, they would ask you to do a balance sheet, so make sure you're aware of how to do that. Just quickly looking here at the theory that you have at the end of it. If we have the wrong closing stock, well then that means that our cost of sales would be wrong, and that means that our gross profit would be wrong and our overall net profit would be wrong. And the big implication of that is if we've undervalued our closing stock, which means that our cost of sales is bigger, we then have less profit, which means we pay less tax. And that's something that the tax man would frown upon, and it means that we're more likely to have an inspection, which is called a tax audit. So that's a serious risk for the business. So we need to make sure that we have a pretty good valuation for closing stock that we can stand over. Otherwise, we're likely to be inspected more often by the tax man.